Good evening, everyone. Thanks for listening in. This is Cale Smith from IIM Investment Management. It is late October 2022, and this is a Q&A style slideshow that we're going to call the 2022 Macro Mailbag. I have a lot to cover. I got a number of macroeconomic slides to walk through tonight, specifically to answer a lot of questions we've been getting lately. A couple of quick things before we begin. Here at IIM, we spend zero time attempting to forecast what the U.S. economy will do. We are a bottoms-up fundamental value investing firm. Value strategies in general are doing relatively well in 2022, especially in energy. Years like this are a good reminder that valuations matter for sure. What we spend almost all of our time here doing is looking at businesses and making business predictions about what those individual businesses will do and how their cash flows should grow over time, and compare that to the price we had to pay for them. When it comes to macroeconomics, however, I would summarize our approach as it's important to monitor, but it's a mistake to try and predict. There's just too many variables in the broad economy to consistently and accurately predict the future. And look, the truth is you just got to expect there will be good times and bad times. The way that we minimize the impact of economic slowdowns on the stocks we own here is really to make sure we care a whole lot about the prices we pay in terms of valuation specifically. That said, there's also no denying that there's a lot going on out there today and all year long, really. And we get a lot of questions about it, which I absolutely understand. So I thought this slideshow might help. Going to go into some pretty wonky detail in a lot of these slides in here in a little while, but here is the TLDR version, which stands for too long didn't read, or at least that's what my teenagers told me it did. We'll give you the very abbreviated version, so kind of get the gist of it, and then perhaps later on, if you want to drill into the individual slides in the subsequent videos, you can do that at your convenience. So we'll try to do 3 slides in about 3 minutes and summarize things up front here. So what's the problem? First part of that answer is inflation. We basically stopped the world economy to combat COVID, and central banks, including the Fed here in the U.S., reacted vigorously. The U.S. alone, we did about $3 trillion in stimulus. It worked. The economy subsequently got too hot. Prices started to rise a lot, and the Fed's got to fix it before it becomes even a bigger problem. The second half of that answer is the market is nervous about the Fed's approach to inflation and really appearing to be stuck between a rock and a hard place when it comes to interest rates, which are the primary tool to fight inflation. If rates rise too sharply, that cools demand too much and we get a recession. If rates don't rise enough, inflation increases even higher, which is even worse. So we're seeing the market trying to come to grip with that issue as we speak. Question 2, how bad is it? Good news, bad news here. The bad news is that economists now put the probability of recession in the next 12 months at a little over 60%. They expect GDP to contract a bit in the first half of 2023, including some job losses. The good news is that they still expect the economy to grow overall in 2023, which means a recession, if we get it, should be mild and short. There are also some bright spots in the economy at the moment, which are getting kind of obscured because of all that negative sentiment. It all kind of feels worse than it actually is at the moment anyways. Most of the angst out there right now is about what might happen rather than what has happened. And you kind of get a glimpse of that in this bar chart here. The other good news here is that economists are frankly terrible at forecasting. Let's not forget they missed the Great Recession, the dot-com crash, the crypto bubble. negative yields on trillions of dollars worth of bonds in the interim, etc. So again, this is opinion, not destiny here as well. And the final TLDR slide, what are we going to do about it? The short version here at IIM is we are going to grind it out. We're going to stay opportunistic, keep focused on the long term, and in general just be what I call defiantly optimistic. And that is because of valuations, or said another way, that's because of math. For long-term investors, the gains that you'll see in the good times are multiples of the losses you will see in the bad times. So if you take that plus the fact that it's impossible to predict the market in the short term, then you're left with the optimal strategy being really just to grind it out. I'm not saying it's pleasant, I'm just saying history says it will be worth it. And though you may think you can time the market, you may think you can get out as things get bad and then get back in real quick right before it improves. Nah, I mean, you really can't. So all this has happened before, and it will all happen again. The question really is what to do about it. And all the slides that follow really, at a high level, paint a picture of that same idea, the case for intentionally sitting still. In the end, volatility is really just like the weather. You're going to get some storms, but eventually they're going to end, and how you behaved in the middle of the storm is going to matter a whole lot more later than you might think. Okay, so that's the TLDR version. A couple more quick admin notes before we start drilling down. Again, it has been a great year for energy. I am not getting into that here in this slideshow, however. I'll be doing another Q&A on energy and the Tarpon Fund soon enough, so stay tuned. And then the other thing I point out is the biggest factor that we're not going to talk about in these slides at all, really, is Russia's invasion of Ukraine and all the geopolitics around that. That's more a discussion related to global energy than U.S. macroeconomics specifically, at least for the time being. And it's the macro side that's going to be our focus here. Okay, let's start drilling down. By far the most expensive slide in this whole show. So greetings from our compliance lawyer. Okay, now we can get into it.